What I'm doing here, Julia, is I'm warning your audience. A triumvirate of bubbles, credit, equities, and real estate will crash from record levels soon. And you have to gear your investments towards that dynamic of busts and booms during inflation and deflation.
Michael Pento, president of Pento Portfolio Strategies. It is so great to welcome you back on the show and great to see you again. Thank you so much for taking the time to join us today.
It is always a pleasure to be with you, Julia.
Well, I have to say, this audience loves you and I love having you on and I love listening to you and learning from you. And it's been a while. I feel like we must have had you like around the summertime, September maybe. So a lot has happened since then. And I just am dying to get the update. So let's start where we always start, Michael, that big picture, macro view. Where are we today? And as you know, you can take all the time you need to set the table on this show. We do not interrupt our guest.
Well, thank you for that. I do appreciate it. Well, first of all, let me give you my impressions of Powell's testimony before Congress. He was on Capitol Hill. It used to be called the Humphrey Hawkins testimony. And what got my anger up a little bit is he was doing a victory lap over inflation. You know, it's very political. I mean, the questions that these congressmen and senators ask is so ridiculous. Most of them, 99% of them. But he's doing a victory lap on inflation. And I got to thinking, wait a second. I went back and looked at the data myself. So the Fed has an inflation target of 2%. And I'm going to answer your question, by the way. So let me just set the table for you. Because inflation hits me right square in the eyes here because I have to start my conversation off with inflation. So the Fed has an asinine inflation target of 2%. They have been, and that's average inflation. So it can be a little bit above that, a little below that, but it should average 2% over time. The Fed is doing a victory lap over inflation, even though the rate of CPI has been above 2% for just 2 months shy of 4 freaking years, north of 2%. And he's, crowing about having inflation fall from 9% to 3%, even though it's rising faster and further away from his 2% target. But here's the main kicker is that inflation has already bankrupted the bottom 3 quintiles of consumers. And in fact, I actually did some shopping this morning, Julia, for our show. and I'm looking at there's prices on things, and I'm not just talking about eggs, that I have never seen before. Now, it doesn't really bother me that much. The 1%ers don't really care as much as the people that Powell professes to care the most about, which is the poor. He's destroyed the purchasing power of the currency against hard assets, but also against houses and eggs and energy and insurance. So it's so sad. And that brings me to the point that I'm trying to make here about where we are sitting here. We're sitting at a position where the $5 trillion that the Fed printed post-COVID is kept the bubble afloat. It's kept real estate afloat. It's kept the equity bubble afloat. And it has kept the credit bubble afloat. But that liquidity is slowly draining. And I'll give you an example. What I mean by that. So the Fed created something called the reverse repo facility. It's another way of the Fed to take back some of the reserves and pay the banks interest so they don't loan them out and create hyperinflation. We only had 9% inflation, not hyperinflation. But the reverse repo facility at one point was $2.3 trillion. Today it's $67 billion. So that is money coming out of the reverse repo facility, which is the money was laying fallow at the Fed, getting interest for the banks. The banks took that money and bought treasuries, and that's new money supply, a constant flow of QE coming into the economy. That's almost gone. But then I think about reserves in the system. Total reserves are over $3 trillion. They were almost nothing prior to the global financial crisis. Those reserves have to come out of the system. So you're having a lot of liquidity boosting the top, 1 quintile, top 20% of consumers who are looking at their stock portfolios and looking at their real estate portfolios and say, wow, this is great. But as that liquidity comes out, It's like the hot air balloon is getting deprived of that lift. The air is getting shut down, and that balloon is going to crash. And that's a triumvirate of bubbles that will absolutely crash. Do I sound like a Cassandra? Well, maybe. Do I sound like a broken record? Well, maybe. But listen, I manage money for a living. I am not short the stock market yet. What I'm doing here, Julia, is I'm warning your audience that these triumvirate of bubbles, credit, equities, and real estate, will crash from record levels soon. I don't know if it's, next year or this year. I don't know, but it will crash. And if you're not prepared to invest in a way that gears your assets towards depressions and deflations, and then intractable inflations, at different times, because that's what they're going to do. They're going to suffer, I think, a deflationary depression. And then the Fed is going to come in with the Treasury to try to reflate the asset bubble because they have no choice. Once the money markets freeze, they have no choice. And you have to gear your investments towards that dynamic of busts and booms in that the dynamic between inflation and deflation.
I think that is an awesome frame up to the conversation. Okay, to recap, the triumvirate of bubbles, we have the real estate, credit, and stock bubbles. When you talk about the crash of these bubbles as they deflate, can you give us some more meat on the bones? Like, what are you talking about? Like, what kind of correction do you have, an outlook there? Are you talking about what are we talking about? Like 50%? What are we talking about?
Well, I'll give you some meat on the bones. It's a great, that's why you're a great interviewer. It's nice that I say that we're in a bubble. But what the heck what's your evidence? What evidence do you have? Well, let's start with one metric. You look at the total market cap of equities as a percentage of GDP. It is well over 200% as we record this interview today. Now, the normal metric there, that normal ratio, is below 100%. It was just above 100% prior to the global financial crisis. It was 135% at the peak of the NASDAQ bubble before the NASDAQ lost 80% of its value. We're now well over 200%. And that's not the only evidence of an equity bubble. If you look at price to sales on the S&P 500, a record high. If you look at the risk premium, which is the inverse of the PE ratio minus a safe asset like Treasury, it's negative. You get paid more to have a safe investment like a U.S. Treasury than you do on the earnings yield of stocks. The number of the family's allocation, so investors' allocation, American allocation to stocks, is at a record high, 64.5%. So that's the record high percentage of their assets own equities. Never before has been that high. In fact, I take that back. Only one time in history was it this high, and it was in the year 2000. So there is a massive and unprecedented equity bubble. Now, we've had equity bubbles before, not quite this big, but they've existed in isolation, Julia. But then when you combine the real estate bubble, if you look at the home price to income ratio, it has never before been this high. And then when you throw in insurance and taxes and maintenance costs, the ability for the average American to own a house has never been further out of reach. Now, we've had real estate bubbles in the past, in the aughts, circa 2006. That asset bursted, mortgage-backed securities collapsed, and banks went bankrupt. Home prices dropped by 33%. But it was a real estate bubble, not an equity bubble, not a credit bubble. And now you have those two bubbles, and you add the credit bubble. If you look at the total non-financial debt of the United States as a percentage of GDP, it's 265%. It has never been higher. If you look at the record amount of junk bonds that have been issued, the record amount of things like never even existed before, like private credit. You're a business and you can't get a loan from a bank, and you can't float debt. You can't borrow money in the bond market. You go to the shadow banking system and ask them for a loan. Mm-hmm. And then that's packaged up and sold to Wall Street. It's illiquid. It's non-transparent. But that industry has ballooned from basically zero to $1.5 trillion worth. There's a credit bubble, an equity bubble, and a real estate bubble. If you look at the mean reversion of those things, and I think they will burst concurrently, I think that you're looking at a 50% correction at a minimum. Now, I'm not saying it's going to happen now. Again, Julia, I manage money for a living, and I have no shorts in my portfolio. I only have one tiny short. It's a high yield short. It's about 1% of the portfolio. I'm long, I'm diversified, but I'm cognizant of the fact, and I have a model that predicts when I need to understand when the liquidity becomes a problem, when that liquidity is drained. And as I just mentioned to you, the reverse repo facility, a big part of that liquidity is already gone. I don't know how much or how many reserves are needed to keep the financial system floating. Like I said, there's like there's a little bit over $3 trillion in reserves. It certainly isn't below 2. So maybe it's a year. These reserves are coming out of the system. The Fed's balance sheet is shrinking. They're destroying base money supply, which is the building blocks of all monetary aggregates. As that money gets drained out of the system, you will see a problem in the repo market. You won't be able to float commercial paper. The market will start to crash. That might be engendered by a housing crisis. It might be engendered by an equity crisis. They're all going to crash pretty much simultaneously. And it's my responsibility to identify the problem. I think I just did that for your audience. I can go further into detail. People want to look me up. I'll give you even more data on that. To identify the crisis ahead of time and get out of harm's way before this thing collapses, and it will.
The last time we had you on, you did discuss these 3 bubbles. We spoke before the election. We have Trump 2.0 taking shape. Has that mitigated any of this or changed this? Or is there a catalyst for the bubbles bursting? I'm just curious with the new change of administration, how that's altered the thesis or maybe reinforced it.
Well, I mean, I'm a libertarian, so I don't want to get too political here. I voted for Donald Trump in complete candor. I think he's going to be a far better alternative than Kamala Harris. But just because we elected Donald Trump doesn't make these bubbles disappear. Listen, when Trump passed the tax cuts originally and brought the corporate rate down significantly, it was 2017, 2018. There was a significant boost to GDP growth. We're looking now at extending the Trump tax cuts, maybe with a very, very, very narrow margin in the House and the Senate. But what we do see right now is deportations, government firings, and tariffs. So there's offsets here. So having Trump as president is not a panacea.
What if you can grow your gold so you're not just preserving, but you're growing your wealth in an asset that can't be inflated away by money printing? Monetary Metals lets you do just that. You can earn 3% on gold, paid in gold in their secure gold leasing program. And if you're an accredited investor, you can earn even higher yields in their bond offerings. Previous bond offerings have paid 6%, 12%, and even as high as 19%. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning interest in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. So on the liquidity front and how critical the liquidity component is to all of this, what will you be watching specifically? And maybe what can recommend this audience that can go follow you and subscribe. I know you have your midweek reports as well that they could subscribe to, but just take us a bit more inside that. Give us some color, like what to pay attention to as it relates to liquidity.
So I think of liquidity, I think of the level of real Fed funds rate, which has been positive for well over a year now. That has been very significant in the past. When borrowing costs are negative, like they were for 10 of the last 14 years, that tends to get investors to say, well, let me just borrow money in the bank and just buy something like a house. or gold or the stock market, anything, because I'm borrowing for less than the cost of inflation. So it's an easy calculation. But when money has a real cost, it tends to dry up the impetus to borrow money. So that's one thing I'm looking at. I look at the reverse repo facility. I look at the reserves in the system. I look at the Treasury general account. So I have a 20-point model that measures and maps this liquidity. I look at the bank lending standards. What are the banks doing with the reserves that they have in the system? I look at the copper gold ratio. So there's like I said, 20 components to my model, and that makes sure that I'm on the right side. I look at credit spreads. I look at financial conditions, and it's a really thorough and somewhat arcane puzzle that I put together to let me know what is happening regarding the second derivative of inflation in the context of growth. And when you have the market run into problems, it's usually derived from recessions or liquidity crises. That's when you really need to get the heck out of harm's way. Mm-hmm. And this is exactly what this model does. It lets me know when we're going to have a protracted and investable decline in the stock market. Most recessions in the past have averaged a decline of 35 to 37%. That's the average decline. Some have been 50 and some have been 80, depending on the index. I have no reason to doubt that the market will correct by 50%, just to bring it back into some kind of normal historical mean. But there are people who think that the Fed can just rescue us by returning to QE and ZIRP, and along with the Treasury, just print up a bunch of money. But here's the one thing that's changed since 1981. We finally have a real problem with inflation. Like I said at the start of the program, inflation has already bankrupted the bottom three quintiles. These people are very much suffering. They're finding it difficult to heat their house and to put shelter over their heads. So, and cool their house, and to drive, and to afford insurance. So, if the Fed and the Treasury join hands now and decided to monetize some kind of form of helicopter money like they did last time, where the Treasury just borrows trillions of dollars and the Fed prints it all for the banks to supply, you could get an enormous spike in long-term interest rates. And if you have an enormous spike in long-term interest rates because they have the lack of confidence, by the way, the Fed does not control long-term interest rates. They control mostly the money market. So the Fed fund, overnight interbank lending rate, and thus the money market rate. If we get a spike in long-term interest rates because of inflation and insolvency fears, then we can have a real problem in the stock market and in the real estate market that is not fixed, not easily fixed by all this liquidity. It just causes people to panic. You know, I just want to add that the last two recessions that we had, the deficit increased by 300%. So you're looking at you can have a U.S. deficit of $6 trillion the next time we have a recession, because these automatic stabilizers just kick in, and people get the food stamps, they get the unemployment insurance. There's no act of Congress; it just kicks in. Revenue dries up and expenditures surge. $6 trillion. At what price is that debt going to be purchased, and who's going to buy it? And what's the cost to inflation? These are the things that I think about.
Yeah. Okay. So let's say like these bubbles burst, and could it create like a bit of a reset, if you will? Because it's, as you point out, like really it's only the upper echelons who've really, the top 1%, if you will, who've really benefited from these asset price increases. I don't even know if that's a good question, but I kind of wonder, like, what would, if we had like a natural state of things, like where would we be if things operated naturally, and could there be an opportunity? I'm just trying to think if there's any silver lining to this, if you will.
Well, hurricanes absorb a lot of energy from the ocean of heat and dissipate that, and it forces in the world that they tend to look for stabilization. So the good news is that if real estate prices collapse and if the stock market returns to some semblance of normalcy, you might not have such a bifurcation in society any longer where we have the very wealthy and then you have the poor. I mean, you'll actually invigorate the middle class. That's one of the silver linings.
Yeah, I can say that as someone who wants to buy a home. That, yeah, it's, and I know I talk about all the time on this channel, but you were right though, just the affordability, it's just not there. It's crazy. And all of the other costs that come with home ownership as well, as you pointed out at the top. Okay. A lot of folks, when I said you were coming on, they were especially keen to have you on because of inflation. And we've had the CPI this week, the PPI this morning. Curious, what do you think the move is for the Fed come March?
Nothing. Well, the Fed's trapped. The Fed is trapped. They have this loosening bias, and they were supposed to cut rates, I think, 4 or 5 times in 2025. That's not going to happen. The Fed can't cut rates. They want to cut rates, and the reason, the primary reason why they want to cut rates, in my opinion, is the Treasury can't afford to pay $1 trillion of interest on the national debt. You know, Yellen floated all of our debt at the very short end of the yield curve. So she has to roll over this debt constantly. Mm-hmm. Well, the money market rate competes with the Fed funds rate. And if the Fed can get the money market rate down to, say, 2 or 3%, that would be wonderful. Cut a lot of this interest expense off. But they can't do it because inflation is, as I said on the top, it's almost 4 years above their 2% target. And it's moving further away from that target. We had a PPI data today. It was 3.5% year over year. Core rate of inflation is 3.3%. Those are much higher than they were in the previous month. So it's going away from the Fed. There's no way that they can lower rates right now, so they're stuck. Although I think they would really, really want to, just to help out Janet Yellen and the interest expense on the national debt, which is $36 trillion today.
Mm-hmm. So I imagine she's left Scott Bessent quite a mess then at the Treasury.
Yeah, these are like when you say, well, Trump, is the president. We're happy to have him as president, but doesn't solve the problem. I wanted to touch on this before I, make sure I touch on this before the interview ends. There was somebody in power, I think it was somebody at the New York Times. I might be wrong about that, but wrote an article about how we could revalue gold.
That was my next question for you. I saw that at the Treasury.
Yeah. Well, I don't know if Trump is talking about this or if Bessent is talking about this, but I think the Fed has the Treasury has 261 million ounces of gold, I believe.
Valued at $42 an ounce. Yeah.
Yeah. That at $42 an ounce. So if they, the Fed, the Treasury, they can all play all these accounting gimmicks and tricks. Look, listen, they have about $750 billion worth of gold at the Treasury. I don't care if they value it at $42 or $3,000 an ounce. Doesn't matter to me. The market value of the gold hasn't changed. The position of the Treasury's assets has not changed. Here's where it gets a little funky though. Apparently, if they revalue gold to a market price of $3,000 an ounce, that somehow enables the Fed to repo that gold. In other words, print money out of nothing and hand it to the Treasury. And then the Treasury general account would have 750 billion newly created dollars, which they then could just buy down the debt, which would be a flood of it would be like a $750 billion overnight QE program. Now, that doesn't really do a huge dent in the national debt. And really it only brings the deficit down a little bit. It's not such a big deal. And then I heard there was a rumor, Julia, that they were going to revalue the gold to like $142,000 an ounce. And then pay off the whole thing. Just get rid of the whole thing. That's Zimbabwe kind of talk. That's just ridiculous. There's no magic here. They can play accounting tricks if they want to. But all the government can really do is inflate away the problem, be it by revaluing gold or not. Now, I would have no problem if the Treasury sold its gold. on the open market. It would not care at all. But then the Treasury would reap the reward of selling that gold and then have no more gold to back its currency, which would be a whole other problem. So these are just games, and they will not amount to anything.
Okay. I imagine though, Michael, you're probably someone do you think about like what are the potential solutions here? Like I'm just looking right now, the US debt clock, 36.47 trillion, ticking higher, but we also have the Doge clock there, 90.6 billion saved with Doge. What would be do you see a way out of our debt situation?
I do see a way out. Do I see an easy way out, a painless way? No. And there's no innocuous solution here. You know, if you ran up in a tremendous amount of credit card debt that you can't afford to pay back, you could print it away if you had a Al Capone's printing press in your basement. You could try that. But you're going to have to default on this debt, and it's going to bring your living standards down. You're living high in the hog. You're going taking vacations. You're buying cards, racking up all this debt, and then your living standards are going to crash because you're going to try to pay this debt back. You could also default on the debt, and now it's the bank's problem. $36 trillion. I mean, if you owe $100 to the bank and you default, it's your problem. If you owe $36 trillion to people, it's somebody else's problem. It's the ownership of the debt. It's the pension plans, and it's the shadow banking system, and it's the regular banking system. It's foreigners that have the problem. It's the primary dealers that have the problem. So there is no easy way out of this. It's either going to be done the correct way, the real way, which is an explicit default. Hey, we can't pay this debt off. We didn't even talk about unfunded obligations. Forget about 36 trillion.
Yeah, it's bigger than that.
Yeah, it's hundreds of trillion. So you either can explicitly default, hey, we cannot pay your Social Security, Medicare, and Medicaid. Can't do it. We're going to default on that. Or you could monetize it away by just printing $1 trillion, minting $1 trillion coin or printing trillions of dollars. Either one of those two things or some combination of those things is going to happen, and there is pain, a lot of pain involved in either way. Because don't forget, someone's debt is someone else's asset. So someone's going to lose. Maybe both.
Yeah. Oh, I guess you're right. It's pain no matter which way you look at it. All right. So when I was listening to you earlier at the top, you're still long in the market, but not overly long. So I guess for folks watching and listening, if you can share, like, what is it that will make you change, or like, what is your thought? Like, I imagine you probably at some point you said you want to go short. Are you one of these guys that also, when things do fall, will want to like deploy capital again as well? Because I've gotten a lot of questions, emails from folks asking about like, just how does someone even think about dry powder, if you will?
Wouldn't it be wonderful if I look forward to the day where the stock market craters and I'm sitting there with all this cash and liquidity, and I can jump in and buy quality U.S. companies with a big, fat, solid dividend and with a level of safety that we haven't enjoyed in decades. I welcome it. Wouldn't that be nice? That'd be wonderful. But right now, that's not the case. In fact, if you look at a lot of the metrics I mentioned at the top of the program, I have the overvaluation of equities. The average annual return over 10 years, the average annual return is like minus 0.3%. So that's the average. Now, that doesn't mean you can't get 5% in 25 and 2% in 26 and then minus 30% in 27. It's going to be highly stochastic, the year's returns. But the average, if you average them all out, is a negative sign based on the valuations of today's market. So you mentioned my portfolio right now. I have a lot of minimum volatility exposure. We're about 20% net long. We have gold. We have inflation hedges. And we're comfortable with that. We have a lot of short-term U.S. Treasuries too, just spinning off over 4% income into the portfolio. We're happy with that right now. because of what I just said. I don't want to, what I want to do is understand that the amount of upside in the market is very limited right now. And the potential for a magnificent and significant and salient downside correction is very, very high. And I'll use my timing model, which tells me right now I don't need today. Right now, I do not need protection on the downside. I don't have any. But when I do see my model signal that we're heading for what I call sector one, which is just deflation and recession, I'll go into higher levels of cash. I will hold treasuries. I will be long the US dollar, and I will short the market. And when the market, if the market crashes and I get the timing somewhat correct, I should be able to make money for my clients, because those four asset classes will either not go down or appreciate in value. And then be able to be in a position to pick up the pieces, because you can make, if you think about this, Julia, if you bought the market in March of 2009, what a wonderful thing you could have done for your clients. If you could have bought treasuries in 1981, 30-year treasuries yielding double digits, what a great move. So this is what bothers me about my industry, which I've been involved in for 34 years. A lot of people get paid just to be salesmen and women. They're salespeople. They say, let me have your money. I'll invest it in the stock market. And, I'll kind of closet index the S&P 500. I'll buy some bonds with that, maybe some overseas stocks. And don't call me, please, when the market crashes, because all I'm going to tell you is, hey, it's time in the market, not timing the market. But if you have a robust model, what you can do is you can say, well, what asset classes do I want to own, and when? Do I want to overweight bonds here, or do I want to short bonds? Are we in inflation, or are we in deflation? Are we in recession, or are we in a boom? And doesn't that make sense? I mean, I'm sure I made that clear, just in case.
Yeah.
Suppose I said to you that I want to go short the bond market in 1981 because of inflation, because I thought inflation was going to get worse. It would have been a disaster. But what if you could buy bonds and buy equities in 1981? What a great move that would have been. So today, you see equities at all-time high valuations, ownership of stocks as a percentage of assets for American families at an all-time record high, valuations through the roof, as I said. Is that when you want to overweight equities, or is that when you want to be a little more cautious? So just be a little smart, be a little more of an active manager. Understand when you should short the market, because there's a tremendous amount of money to be made on the downside. And it's going to be a beautiful reconciliation of stocks, because wouldn't it be, and asset prices, because wouldn't it be great if Julia could afford to buy a house and not spend, 40%, 50% of her income on mortgage payments and rent or rent payments? That's not normal. That's not right. So, it's not that I'm not a nefarious individual. I wish the best for this country. I pray for this country, love this country, but you can only live in a fantasy for so long. And the asset prices in stocks and equities and the corporate bond bubble has gotten to a disastrous and it's become a monstrosity, and it must correct.
Well, Michael, I appreciate your candor. And I think that's one of the reasons why this audience loves you so much. Like when they get excited when I say Michael's coming on, tomorrow. And so they get excited every time you are on this channel. And you are always, always welcome on this channel. We love having you on. We love listening to you, learning from you. And I hope you keep that style. Don't be like the other money managers out there. Keep doing your thing and truth telling, if you will. I want to give you the final few moments here. Let folks know where they can learn more about Pento Portfolio Strategies. I misnamed it earlier, but the midweek reality check, I know folks can subscribe to that. I've subscribed. It's an annual subscription. And any parting thoughts, anything that you would like to leave this audience to think about? The floor is all yours, Michael.
Thank you again for having me on. It's a pleasure to be on your program. Like you said, the midweek reality check, it's $50 a year. There's a 5-week free trial. I give you my 36,000 foot view of macroeconomics with an unbiased approach. And so I own an RIA, so I don't have any office, front office telling me I have to sell this bond or this stock. I ask myself this question: where is my assets, my personal assets, and my clients' assets best treated right now, given the second derivative of inflation and growth? If you have $100,000 to invest and you're a U.S. citizen, then you can contact my office from the webpage, and then we'll vet you out to see if you're qualified for the IDEC portfolio, the inflation, deflation, economic cycle portfolio. And just to wrap it up, I think it's imperative for people to listen to shows like yours, Julia, because you don't really get this in the mainstream financial media. You don't get the real data and the real takeaway because everybody's so biased. I mean, just think of, I shouldn't even have said this, but the Bitcoin, I have to say. So the Bitcoin crowd, it bothers me, not that there's a Bitcoin, because I love the concept of a immutable, private, what's that the word?
Ledger, blockchain.
A digital ledger that is immutable and it's decentralized. That was the word I'm looking for. But then you have Wall Street come in and co-opt the whole thing. And then they push the prices through the roof because they're paid to pump this asset. We don't want that here. We want to just ask ourselves a very unbiased question: where is the money best treated? And even if you don't invest with me, find an active manager who understands that dynamic between inflation, deflation, and booms and busts. And you can be much more in a much better position to enjoy your retirement and keep your purchasing power no matter what they do.
Michael Pento, founder and president of Pento Portfolio Strategies. Thank you so much for being so generous with your time, your knowledge, all of your ideas, your wisdom. You're always welcome on this channel. Thanks again. And until next time, be well.
Thanks again, Julia.